Yo guys, I am back with a good one today. This is a fan favorite strategy that is going to work very well in a red or bear market. It's been making me about $5,000 per week. I'll show you guys my account live, but this is one of these strategies that myself and countless others that I work with turn to every single time the market starts dropping. And I promise you that by the end of this video, you'll be ready to place this trade on the next red week in the market and make an easy couple hundred or even extra couple $1,000s in your account. So before I actually show you the strategy, I'm going to pop up my account here so you can see that I have a multi six-figure open profit loss on this trade. And this doesn't even include the option premium that I received hundreds of times that I've placed this trade over the last few years. Now, one of my most frequent critiques with the strategies that I trade, which are option selling strategies, is that people in the comments ramble on about how selling cash secured puts and spreads only works in a bull run and basically how I'm going to get my ass handed to me and all this stuff. But guys, come on. Did you really think that I didn't have a trade in the toolkit that works just as well in a bear market? Not only do I have one that works, this hidden VXX strategy has historically been my highest probability trade and requires you to have about 10 brain cells and 5 minutes of time to place it. So before I break down this very simple VXX strategy, if you are new here, my name is John. I did a little over $2 million in profit last year trading option selling strategies like the one I'm about to explain. And yes, you can download my real 1099 in the description and scroll through all the trades I track and share all my trades live every single day to over 300 qualified traders. You can book a call with me this week with me personally, not someone else, me, myself. I'll take the call. If you want help implementing these strategies that I'm about to talk to you into your account and, kind of tailor them to your account size and risk tolerance. But without further ado, let's get into the strategy. I'm going to break it down on the whiteboard. All right, we are back on the whiteboard here, guys, with a good one. This is going to be on a VXX strategy. It's going to work in every bear market. Every time the market goes down, this is the option selling strategy I turn to, and that is selling short calls or selling naked calls on VXX, whatever you want to call it. So before we actually get into the strategy, I want to make sure that you guys understand that you have to have the highest tier option level unlocked to sell unsecured calls. So in other words, selling an unsecured call means you don't own shares, but you're selling to open a call. So you're going to have to go to your individual brokerage and figure out what tier you need to actually do this. Okay. So what is the strategy? We're going to take it and kind of do 5 steps, right? So step number 1 is on market drops. We're going to sell to open VXX calls 7 to 14 days to expiration and with a 30 to 40 delta strike. So what does this mean? So you're selling to open VXX calls, and for doing so, you're going to receive a premium up front. So this is going to be a credit into your account for selling to open those calls. 7 to 14 days till expiration, so we don't have a very long exposure just in case the market really takes a turn for the worst. And then to choose which strike price we're going to sell those calls at, we're going to choose something between a 30 to 40 delta strike. So this means that there's about a 60 to 70% probability that the VXX actually stays below that call strike price, and then you just collect this premium and you don't actually have to do anything as far as being short shares of VXX. All right, so let's go through step 2 here. If VXX keeps rising, we're going to sell to open more VXX calls, and think of this kind of like averaging down. So I'll show you this on the chart here, but essentially what I'm saying is, as the market goes down and VXX starts going up, and maybe I could, kind of draw this. So if the market's going down, that VXX chart is going to keep going up, and we're going to kind of just average in at each little spike and sell more and more calls. All right, so step 3, if you are assigned short shares, and I've been clowned before for saying assign short shares. I'm just saying if you end up short VXX shares, you're going to hold and ride VXX back down as the market corrects or kind of recovers. And I'll show you this on the chart after we're done these steps. Step number 4 is going to be selling covered puts on those short shares. So if you guys are familiar with the wheel, which I trade a lot of, normally if you sell to open a cash secured put, what would happen is you would end up long 100 shares per option contract. In this case, we're short 100 shares per contract. So instead of selling a covered call like we're used to, we're actually selling what's called a covered put. Kind of like, I like to think of this as like the upside down wheel. Now, if this is all just gibberish to you, but you know it's something you want to get into and you see some serious money, like I said, guys, you can go to optionlab.com and click this button. You can book a 15-minute call with me personally, and I'll kind of explain my community and how I can implement these strategies in your account. But anyway, let's go to the chart here and actually go through these steps. Okay, so on the market drops, we're going to sell to open VIX calls. So this right here is VXX. And as you can see here, over time, the beauty of this chart is that VXX slowly bleeds to zero over time. Now, if we see in these little spurts here, it really jumps up. And that's when we're going to want to do, that's where we're going to want to sell calls, right? So right here, and I believe this is a 3-year chart. I think this is a 3-year chart, but you can see here that every time, we've had these kind of little blips up, it's continuously bled down. So we're going to take advantage of those blips up, sell to open calls, collect premium, and then if we do end up short shares, we're just going to ride those shares of VXX down. All right, so like the first instance here, we'd sell, calls right here. The next blip, we'd sell calls. And if any one of these, if the instance sort of happened where this VXX rises above our call strike price by expiration, and we end up minus 100 shares of VXX, we just hold those shares and eventually buy those back for a lower price than we got them at. As you can see over time, this has just historically worked very well. All right, so let's just go through kind of like an example here, and just so you guys can kind of see a step by step. So let's say that this is the VXX chart right there. All right. So what we're going to do is, this is, VXX. So one kind of basic relationship to understand here, and I talk more about this, with a little bit more time, but as the market drops, VXX is going to go up. Volatility is obviously going up. As volatility goes up, option premium, or the money that we receive for entering a selling to open or a, like selling to open calls, is going to be more lucrative. You get more premium when volatility is higher. So we want volatility to be higher, and when the market's dropping, volatility is going to be higher. So what we're going to do here is we're going to track down VIX here and just say over time, it kind of bleeds down towards zero, but we see here that it, kind of blips up right here. Okay, so say VIX here, or VXX is at 80, right? So that's the current price. What we're going to do is we're going to find the 30 to 40 delta strike call option, 7 to 14 days till expiration. So say that's the 85 call, and we're going to sell to open that 85 call. And for doing so, we're going to collect a premium, right? So say we get $100 for doing that, for selling one of those calls. So what is the criteria for actually making money in this case? So 2 weeks has now passed. It's Friday. This option is about to expire. How do we actually just keep this premium and not have to worry about anything? How we do that is if VXX stays below our call strike price by expiration. So in this case, if it stays below 85 by that Friday expiration, we keep this premium and we never end up short shares. Now, in the instance that the market continues to drop and VXX just plows up to say 90, right? So now it's expiration day and you're thinking, oh, damn, well, now I'm screwed because it's above my strike price. So what would happen here is you'd end up minus 100 shares of VXX at your call strike price. But the beauty is you get to keep that premium that you receive for selling to open those calls, which means you have a lower cost basis. So in this instance, say you were, short, well, in this case, actually, you'd be short here at a minus 100 shares at 85. right? But remember this chart that VXX over time, over the long period, bleeds towards zero. So now you're short shares with with something that moves down consistently over time. So those minus 100 shares then, as the market corrects, volatility goes down, VXX is going to start trending back down, and you can then sell covered puts on these shares to get rid of them, or you can just buy them back outright, without writing a covered put. But, kind of like what can go wrong with this strategy is, well, this is kind of the basic gist. Again, if you don't, if this sounds like a lot of gibberish, you need me to, kind of help you implement it into your account, you can book a call with me. But when can this go wrong is, if you get short VXX shares during a prolonged market drop, right? So if the market is just continuously going down, volatility and VXX are continue going up, and you end up, you're shorting, and the price that you're short at just continues to go up as the VXX continuously blows through your call strike prices. But like I said, that's happened to me, and over time, I continuously average down on the position, and over time have made a ton of money. This is it actually is the highest probability trade that I take in my account. Look forward to taking this trade every time the market's down or red. So if this was helpful, please leave a like on the video, subscribe, keep an eye out if you like content like this. I post option selling strategies all the time. Remember, click the link in the description, theoptionlab.com, trade with over 300 live traders every single day. You can see all the trades I take. You can book a call with me to help me implement strategies just like this into your account. But anyway, I will see you guys in the next one.